Hello, everyone, and welcome to LPL Market Signals. Jeff Buchbinder here, your host for this week, with my friend and colleague, Adam Turnquist. Adam, thanks for working during this holiday week when few people are. How you doing?
Hey, happy Monday, I guess we'll call it. And happy New Year, of course, to you as well. Glad to be back. I'd like to think it's back by popular demand, but I think it's back by default since a lot of people are out of the office this week.
Well, I'd love to have you on every week. Certainly, our pattern is to rotate around. So you're back both because we like having you back and because of circumstances. It is December 30th, 2024. It's the last time we'll say 2024 in one of these podcast intros. As we're recording this late morning on Monday, and stocks are selling off again. We had down Friday, pretty big down Friday, now pretty big down Monday. And so we start off the agenda with, is Santa visiting markets? Looks like maybe for markets anyway, Santa got stuck in the chimney because we are down since I guess it's the 24th, right? Adam, that starts the Santa Claus rally period, the 5 days.
Officially, yeah, it kicked off on Tuesday, December 24th, wraps up on Friday, the 2nd.
Yeah, so we still have time. Still have three more trading days in this 7-day Santa period that's has historically been a good predictor of market performance, but we'll give you the numbers on that here in a little bit. But right now, looking a little dicey. Next, we'll go through Adam's charts here that'll help answer the question of whether this pullback is almost over. It hasn't been much of a pullback yet, but we'll call it a pullback. We're down a few points from the highs. Third, we're going to walk through the weekly market commentary this week, which is available now on LPL.com. It is about the 2025 outlook, and specifically the 4 keys to a strong market year in 2025. Taking some of the content from the outlook that we published a few weeks ago, and then kind of adding to it, updating it, putting a little bit of a different spin on it. Then we'll close with what I think will be the fastest preview of the week ahead ever, because there's really not much going on. I guess this is not this week, but next week we'll have a market holiday, right, for Jimmy Carter's passing. So we mourn the loss of Jimmy Carter, our 39th president. Lived to 100, and seemed like he did more after he was president than while he was president. I think it's fair to say. Certainly a humanitarian nonetheless. So thoughts and prayers to the Carter family. So let's get into the recap for last week. So Adam, we actually capture 5 days. So this, because we didn't have a market on we didn't have market activity on Wednesday for Christmas. This goes back to the previous Friday. So the 5 days is actually quite strong on the S&P, up 1.8%. But if you just look at last week, 4-day week, we were up 0.7. So still a positive week, but of course we're giving that back today. I mean, my only observation on last week's trading is so many folks were out that was really thin volume, and it's probably not all that meaningful. What do you think?
I think that's fair when you look at trading volume. Very thin throughout the week, even on Friday for a relatively large down day, at least by this year's standards. Pretty light volume overall, and it looked like some of those big tech names coming off the boil a little bit. They've had an impressive rally since the election and getting a little bit overbought. Some of that started to unwind a little bit last week, and that spilled over into the broader market, of course. But you did see small caps actually lag on the week as well. The Russell only up 0.1%, of course, pulling back today. But when you start looking at just the longer term technical damage here, even on the small caps, we're not seeing any major breakdowns. We're still seeing higher lows, price holding above the rising 200-day moving average. So looks more like a pullback from a longer term perspective without a lot of damage at this point.
Yeah, I think at this time of year it makes sense to look at year-to-date returns, right? And wow, the communication services up 43, tech up 40, consumer discretionary up 34. Obviously, it was a big year for growth. Growth up 38 based on the Russell 200 growth index, which is more of a pure large cap index. I mean, that's really the key story of the year for me. If you weren't in those large cap growth stocks, you just didn't do very well. Certainly a lot of active managers this year had trouble with that. I think we're probably in the consensus that is looking for let's call it a narrower range of outperformance from growth versus value next year, maybe even inline performance, because growth has just been so dominant now for so long. Any other observations here about market performance in 2024, Adam, before we move on?
Sticking with the growth theme, it's interesting too to see that reacceleration. A lot of the large cap growth and the big tech trade was put into a consolidation phase really since, call it July into the fall. We started to see that reassert itself, those mega cap names. Just looking at some of the stats at the end of last week, I think since election day, when you look at the Mag 7 components, for example, of the S&P, they've contributed to about 85% of the S&P's gains since election day, and that's over a 4% gain for the S&P. And that price move in those names has really been a big driver here. And of course, that brings up concentration risk that we've talked about ad nauseum here this year, as we've had this theme of a few names driving the market higher. It doesn't seem to be abating anytime soon as we go into 2025.
Yeah, more than half of the year's gain in the S&P 500 was from the Mag 7. Just a massive contributor there. And certainly the international markets couldn't keep up. We know that, although it was a pretty good year for China and Japan, frankly, ex-currency, so in local currency terms, not US dollar terms. So those markets kept up, but Europe, not so much. 19% in Germany, 10% for the broad Euro Stock 600. Just too much to overcome there. Not only do those markets not have a lot of tech, but they have the currency drag. Actually, you see that here on this chart. The dollar was up about 7% for the year, and directly clips international returns for U.S. investors. So that's probably the biggest takeaway from this chart, other than just to say that it's tough here in bonds. And then I've noticed, Adam, that natural gas has been making a run here lately. That's probably just cold weather more than anything else. But anything jump out to you here on commodities, currencies, bonds?
I think when you look at it at the whole level, I think the macro conditions have been a little bit muddied here over the last couple of weeks. Really, since the Fed meeting on December 18th, we've seen the 10-year yields breaking out above key levels, above that 450 resistance level. That does open the door for further upside, at least on a short-term basis. We talked a little bit about the dollar now, 108. That's above a key resistance level, 107. So that means the dollar no longer range bound and potentially entering a new uptrend. Be really interesting to see when earnings come out for Q4, what the corporate commentary is around that dollar. Anytime the dollars move closer to the upper end of that range, we've heard commentary about headwinds at the dollar level. We'll be watching for those kind of comments as we get into earnings season. Little ways off at this point, but that's really on the macro what we're seeing technically. Some of those breakouts could be potential headwinds as we go into 2025.
Yeah, I think consensus for earnings growth in Q4 is something around 12%. So we'll probably get a strong earnings growth figure even with currency drags. It's just possibly going to impact guidance. So it's really, about the 2025 guidance that I think we'll have to watch closely. I think companies, as you suggest, Adam, will be a little more cautious because of that currency effect. So thanks for that. Good stuff. Let's move on to your charts. And here we just pose the question, how much further does this sell-off have to go? I don't really talk about pullbacks typically until we're down 5, but the S&P is near the 50-day. I guess maybe it's breaking the 50-day now as we speak with the Monday sell-off. So what is this chart telling you? How much more pain do you think we have to endure here?
I think if you frame it up quickly, you can use the short-term pain, long-term gain analogy. And we've suffered, I guess it's not technically a pullback without hitting that 5% threshold of a drawdown, but technically here you can see the index pulling back from the upper end of its rising price channel, taking out the 20-day moving average. And then we had a minor relief rally, call it 3 to 4%, coming off that sell-off from the Fed meeting. That died out right at the 20-day moving average. We've subsequently rolled over, took out the 50-day moving average again. So coming into some key support levels in today's price action for this week, we'll be watching 58.60 on the S&P 500. That's the price gap from that post-election day rally. If we break there, you have the December intraday lows right around 58.32, and then 5,700. That goes back to the November lows, we'll call it. So still a lot of support to the downside above the 200-day moving average. I think, down at 20 or 55.48, you can see on the chart there. That would be about a 10%, call it, correction off the high. So nothing out of the ordinary, even if you do check back to the 200-day moving average. It's been over a year since we've revisited that. So I would not be surprised to see that play out potentially on this latest move. But when you look at momentum in the index, something that looks a little different than some of the other minor relief rallies we've witnessed, that bottom panel is the percent price oscillator, PPO as it's labeled there. That's basically a indicator that uses two moving averages to understand or to depict trend and momentum. What we haven't witnessed on the bounce last week was a buy signal in that PPO indicator. You can see some of the other times we revisited that uptrend, you had a buy signal in confirmation, maybe that pullback was over, and we're still negative on that PPO indicator and moving closer to a crossover below the zero line, as you can see on the bottom right, highlighted in red. So momentum fading a bit, that relief rally dissipating again at resistance. So I do think, can't really wave the white flag here suggesting that the pullback or this latest drawdown is over. I do think there's a little more room to run, especially when you look at the market from a breadth perspective. I think on the next chart, we have a breakdown of just a few market breadth metrics that we like to look at. Top panel is the percentage of stocks above their 200-day moving average. We like to use that one because if you think of the most basic definition of an uptrend, if price is above a 200-day moving average, that typically checks the box for an uptrend. And here we're looking at the internals. So how many stocks in the index are actually above their 200-day moving average? For most of this year, it's been very bullish. We've been anywhere from kind of 60 to 80% in this range as we're highlighting. But what happened last week, and really since the Fed sell-off, we started to hit new lows in that indicator. You can see currently about 58% of the index above their 200-day. The fact that we're making new lows, I think, should be a warning sign for investors, more on a short-term basis. The red flag would really be if we start breaking down below 50% on this indicator. When you back test it and look at forward returns, when you're below that 50% threshold, the average 12-month return tends to be pretty below average, we'll call it, for the S&P. So maybe a potential struggle here from some of the breadth metrics we're looking at. And then on the bottom panel, we also have another one we look at. That's the percentage of stocks making new 52-week highs in green and new 52-week lows in red. And what's stood out, we haven't had a new high in the green indicator, the percentage of new 52-week highs since election day, despite the S&P rallying over 4% during that period. So that bearish divergence with price moving higher, breadth moving lower, often is a warning sign for a potential pullback. And then last but not least, we did get a big jump in the number of stocks making new 52-week lows. That actually triggered an indicator called the bloodbath indicator last week. It crossed below or above 4%. We have it inverse labeled here in the inverse. You can see it was almost negative 8%. And the indicator, whenever that goes, we'll call it below negative 4%. That is typically a sell signal. It backtests pretty well. I think the name is a little bit misleading with the bloodbath indicator, but another potential sign here that this pullback might not be over.
Yeah, that's awfully morbid. Well, let's come up with a different name. We'll get back to you maybe in a future podcast with the
Yeah, I like that idea. Some of the technical world can be a little bit more with the death cross as well. We haven't seen that one play out.
The Hindenburg omen is
Yeah,
doesn't,
yeah,
sound so upbeat
it.
either, but yeah, the point holds here clearly. The breadth has been weak. It's been a very popular topic in the market press that suggests maybe more chop ahead, I would say. So point figure, I'm sure we got some Dorsey Wright fans listening here. So what is this? I mean, I guess first explain what point and figure is, and then what is it?
So this chart is we're using the point and figure bullish percent index. For those of you not familiar with point and figure analysis, it's an objective way to track price action. So you use filtered movements in price, often, for example, a 3-box reversal. I'm not going to get too far into the weeds, but price has to go through a certain threshold for point and figure charts to move up or down, and they use columns to dictate the up and down movements of X's and O's. And I like to look at this because it is objective. You have breakouts and breakdowns that you can actually look at across the index. And that's what we're doing in this bottom panel. This is the percentage of S&P stocks with actual point and figure buy signals. And again, we're having another breakdown here to new year-to-date lows. You still have 40% of the index in a buy position based on that point and figure analysis. But what we didn't see is a bounce back like we did in May or even August. Obviously, the market a little bit more oversold in August off that pullback. That was the largest drawdown we witnessed so far, or for this year at 8.5%. But nonetheless, we had a quick rebound at that period with more buy signals coming in. Same thing back in the April-May timeframe. You can see a quick bounce, and we haven't had that bounce. It's been pretty flat here for the bullish percent index, actually at right around 40% today. So the lack of momentum or lack of any type of relief rally within the S&P 500, a little bit of a concern here, especially when you couple that with the divergence we witnessed in the BPI over the last few months. You can see October to December, a lower high in that indicator. Oftentimes that's another warning sign that maybe the latest breakout not so sustainable.
Another piece of evidence suggesting maybe we got a little bit more downside to go potentially. I think of the reasons you would cite for maybe more downside, this is not one of them. This is the average forecast for the S&P 500 by Wall Street strategists, who don't have a great reputation. I guess we're in that group. I guess fortunately or unfortunately. But their track record is not so good. So should people just take this with a grain of salt that Wall Street's so bullish?
You can look at it a few different ways. Maybe from a contrarian perspective, when you look at the rate of change in the strategist price targets, for example, from October to the most current reading at 66.14, that quarterly percentage change is almost a 20% increase in strategist price targets. That's the largest quarter over quarter jump we've witnessed in the sell side strategist price targets since data goes back, I think, to the late 90s in this data set. So we've had a massive jump in bullishness. And I think you can justify that when you look at the macro backdrop. We have a better than expected economy, inflation moving lower. You've talked about the earnings resiliency, potentially double digits earnings growth, maybe for fourth quarter. So there's plenty of reasons, not to mention what the Fed is doing. But here we are at a 10% premium is at least what the top-down strategists are telling us. This is just an aggregation of I think around 30 different strategists on Wall Street, what they come up with for their year-end forecast. A bottoms-up analysis which actually looks at price targets for each S&P company, and that boils up to a price target, is just a little bit above this as well. So both top-down, bottom-up, pointing to, call it maybe 10% gains for the S&P 500. Not completely out of the ordinary. I think when you look at the actual absolute number of a 10% gain, it seems to be in line with what we typically see for forecasts. And it is a tough job, as you know, Jeff, calling the market 12 months ahead. lots can change. So it'll be really, I always like to look at this at year end to kind of put a timestamp on it and where we're at and where we end up being. Of course, last year, sell side strategists not bullish enough on the market, and I think this year and even 2023 surprised a lot of people by the strength of this bull market.
Oh yeah, strategists weren't even close. I think, I mean, we've been riding a 5,500 target for a while for 2024. Of course, that was too low, but more reasonable than a lot of other forecasts, certainly. So I think we did okay there. But if you go back and look at where forecasts were at the end of 2023, you had a lot of, I think the average price target was calling for something like a 2% gain in the S&P 500. Very cautious price targets coming into 2024. Of course, as we know now, the economy far exceeded expectations. Corporate profits far exceeded expectations. Start of this year, that was when inflation was bubbling up, and you had some folks really worried about what we might get from the Fed. Well, fast forward to now, and clearly the market has done a tremendous job of managing through the Fed rate cuts, the slowing of the Fed rate cuts. We didn't get nearly as many as the market thought. So certainly there were a lot of reasons where the market could have sold off, and it just didn't. And certainly the strength of the economy was a big reason for that. So let's go to the Santa Claus rally here, Adam. It looks like Santa is not coming to town based on what I'm seeing in the market today. Through Friday, we were pretty close to break even, suggesting maybe it was 50-50. I know it's hard to predict where markets are going to go when you have thin trading, but do you think we got a chance for a bounce here to get this back over the next few days?
There's still time, and I think we're down about 1.3%, somewhere around there today. And the bogey for the S&P 5974, that's the number to clear. You can see how this 7-day stretch tends to produce well above average return. So as a reminder, it's the last 5 trading days of the year plus the first 2 trading days of the new year. If you go back to 1950, the average return over that 7-year stretch up 1.3%, higher nearly 80% of the time. If you compare that to just the overall 7-day average return of about 0.3%, it does really stick out. And then when you start looking at the implications of a positive or negative Santa Claus rally, as we do on the next page, you can see when Santa shows up and the S&P is higher over that stretch, what January looks like. The average S&P return up 1.4%. versus the average when Santa doesn't show up, you tend to be just slightly negative at negative 0.2%. And the positivity rates also a big gap between them. 64% in January is higher, of course, when Santa shows up versus only 44% when Santa doesn't show. And then the next year returns, you can see average up about 10% when Santa shows up and we're positive. And then on the flip side, when Santa doesn't show up, only about an average return of a 5%. And if you take that average 5% right now, of course, we're leaning negative here on the Santa Claus rally indicator. That'd get you to an S&P based on today's price of around 6,200, just for some perspective. And we're just using that, again, that average price. But it'll be interesting. We got a couple more days left, of course, Thursday and Friday. So we'll see if the market can clear that, again, that bogey at 59.74. That would give us a positive Santa Claus rally. We still have other seasonal data. Of course, the first 5 days of January are another indicator, and then the January barometer. As goes January, so goes the year. So a few others potentially to offset a negative Santa Claus rally. We did get a negative Santa Claus rally last year. Just to give you some context, we tend to not get back-to-back negative Santa Claus rally periods. Only 2 times have we actually had negative periods. You can see, I think back in 2015 and 2016, the market did okay back in 2016, up about 10%. And then in 1993 and 1994. So statistically, odds favor a positive close here. We'll certainly hope for a rebound by the end of day on Friday.
Yeah, LPL Research still expects a pullback at some point fairly soon, but yeah, based on these seasonal patterns, I think there's a chance we recover these losses here from just the last couple of days before what would it be, January 3rd. We'll see. Hard to predict a year out. Hard to predict 3 days out.
Yes.
But anyway, that's kind of my bias, that I think don't put too much stock in this sell-off. It doesn't seem to be based on really much of anything. This is a cool chart, Adam, that you threw in there. I mean, I put it together, but I appreciate you liking it. I think it's a really helpful exercise to go through every year, to look at just how likely the market is to be up in a given year. And I know you have some stats that you can share on this too, but to me, what jumps out at is how unlikely you are to have a big down year. So the message here is stay invested. You see on this chart, there's 75 years on this chart, on this graphic, and there's only 5 that are down big for 15% or more. So you've got pretty good odds that you're either going to be down modestly or up. And then you could also take that further and say, well, the odds of up versus down, it's almost 4-1, right? You have, I think the precise percentage is 74% of the time you're up in a given year versus down. If you take out those big down years, and let's just say we're going to have a modest down year or an up year, you're 4 times as more likely to be up than down. So, can we guarantee it? Obviously not. Could we have a down year? Sure. But the odds going into 2025 favor an up year, and actually you could argue favor a year that's maybe even up more than 10%. What do you think, Adam?
It's really interesting. I love this chart. I'm glad you put it together. I think it's a great one for advisors to have with clients when you just look at the percentages here for the S&P. And a lot of times you'll hear the quote, the average return for the S&P on average, again, going back to 1950, it's up 9.3%. As you mentioned, higher 74% of the time. But given the high positivity rate, I ran the numbers. When the market is higher, what's the average return? And that's about 17% for the market. And when it's negative, it's down about 12%, to give you some additional data points there. But certainly a heavy right skew here for the market. And we're doing some other analysis on this, and you can see kind of the average going back to those price targets for the S&P 500. Generally 5 to 10% of upside is, we'll call that maybe a normal kind of forecast for the year ahead on average. And since 1950, the S&P 500 has only been up in the 5 to 10% range, I think 6 years out of the 70 plus here we're showing. So certainly an outlier type of event to land in that 5 to 10% year. Goes back to how hard it is to forecast the S&P 500, I think, at a high level.
Yeah, we actually have factored this in, I think, in our outlook by saying, like most, we think the market could be up, high single digits, maybe double digits. But we present a bear case and a base case, right? We do that typically every year when we write an outlook for the year ahead. And I think that really makes a lot of sense this year, because there are some issues that could really cause us to break one way or the other, mostly around policy, right? Like tariffs, for example. Just how broad and how deep are those going to cut? That could be a big factor. Do we get tax cuts negotiated next year? That's a big factor in how well markets do. So if all that stuff plays out well to the upside, and I'll get into this more on the next slide, you could easily be up mid-teens, or that 17% average that you cited, Adam. But if they don't break right, we could certainly see a flat year. The economy is still almost certainly going to grow. But that's probably a reasonable range of outcomes. I think at this point we could probably take some of these really severe negatives off the table. I sure hope so. So let's transition to the weekly market commentary. Really quick preview, and then we'll do a really quick week ahead. So the weekly market commentary, which you can find on LPL.com. We highlight 4 keys to a strong year for stocks next year. I just alluded to one, which is policy. So number 1, recession or no recession. We think no recession, so that's probably a likely support. Number 2, supportive Fed. We think we're going to get 2 cuts next year, as long as the inflation trajectory remains in place, gradual disinflation, then we think that can support a couple rate cuts, and market tends to like that. On average, you get about a 5% positive year after the Fed starts cutting. And if you don't get recession, you even see a higher number than that. I think the average is a little over 10. So third, strong earnings. Talked a little bit about that. Not only are we likely to get double-digit earnings growth in Q4, but we could start a string of double-digit earnings growth next year, all 4 quarters. I wouldn't be surprised at all if we had 5 straight quarters of double-digit earnings. Now, obviously, a lot has to happen to make that happen. We need some cooperation, certainly from the policy environment. You even need cooperation from rates and commodities and currencies, a number of factors. But that is a very realistic scenario that will provide support for stocks, we think. And then lastly, policy, fiscal, trade, and regulatory. The regulatory policy is probably the easiest one, right? Because we don't need Congress to do a lot of that stuff. And we know Trump is going to be business friendly with most of his regulatory changes, like he was in his first term. So that's positive. Fiscal, we're going to have deficit spending. So I guess all else equal in 2025, that's positive. But it's when you negotiate the expiration of the Trump tax cuts at the end of next year that we'll have potentially more market volatility. And then trade. If we have a trade war, if China retaliates, for example, if Canada retaliates, if Mexico, who knows? This could go a lot of different ways. But if the tariffs do bite and you have a hit to margins, because these importers have to pay their taxes, basically. The importers have to pay the taxes, and you potentially have retaliation that could affect U.S. companies' ability to compete overseas, right? All of that carries at least the potential to drive markets lower next year. So that's a big risk. The key to the market is if these 4 things deliver more positives than negatives, we think stocks will go higher. So I'll stop there with that. Again, you can read more on the weekly commentary if you so choose. I don't know if Adam, you want to add to that, or you want to just go to the week ahead?
We can go to the week ahead. I think when looking at the keys to the stock market gains, of course, just the sentiment factor as well, how much is priced in versus what reality might come for next year. I think there's quite a bit of bullish sentiment. Maybe that suggests we're due for a little bit of a breather here in this latest rally as some of that sentiment gets worked back a little bit and kind of reset expectations.
Yeah, if I had a 5th key, it would potentially be either geopolitics, which is related to trade, although we still have a couple wars going on, unfortunately, or it would be sentiment, because as you say, there's a lot of bullishness out there, and how the market unwinds that and gets to more of a normal place in terms of sentiment, I think will be another key to 2025 that we talked about in our Outlook publication that we published earlier this month. So thanks for that, Adam. Let's do the quickest preview of the week ahead we've ever done. It's claims, which we get every week, and it's the ISM on Friday. I don't think there's really anything else that's going to be market moving. I don't think those 2 things are going to be market moving. What do you think?
I agree. I think it'll be claims data, what that looks like, maybe make headlines, but I doubt it's going to do a lot of moving the market. Let's hope not. And then, of course, ISM data, which hasn't really aligned with the market as it historically should or has in the past. So that's been discounted a little bit, some of that survey data or soft data.
Yeah, the new orders data maybe is a leading indicator of earnings. So hopefully we'll get another reading above 50 there. It was 50.4 last month. But yeah, the ISM manufacturing data has not been really indicative of anything lately. In fact, we're at a long string. I don't know how long it is, but a long string of sub 50 readings on the ISM manufacturing index. This is more of a services economy, and the services index has been well over 50 lately. So we don't get that until next week, but yeah, I guess if you want to try to make a story out of this week's economic calendar, it's the ISM and not much else. Hopefully folks won't be paying much attention to that because they're going to be celebrating the new year. So Adam, thanks for wrapping up 2024 with me. It was great having you on, and thanks for walking through those charts. Maybe a little more weakness in this market, but not too much, hopefully.
And yeah, short-term pain, long-term gain.
I like that. I like that. And good luck in the LPL Research Fantasy Football Finals.
I'm gonna need it. Thank
you're
you.
A favorite. Your favorite right now with just one game left. We'll have to see. So everybody have a wonderful New Year's. Have a great 2025. We'll be back with you next week for another LPL Market Signals. See you then.